The Jewish secret to risk management. Put 10% at risk. A practical training path for everyday investors. When you first step into investing, it's easy to fall into two traps: tilting when you lose and chasing the crowd when others win. But for a beginner, the first job isn't how much can I make, it's how well can I protect my capital, because risk is always there. If you invest without risk management, you're not investing, you're gambling. That road ends in revenge trades, debt, and heartbreak. Investing is a long game, so the most important rule at the start isn't how big your account is or what return you dream about, it's don't blow up. The longer you stay in the game, the higher your odds of winning. That mindset echoes lessons from many Jewish thinkers and practitioners. Humility before risk, discipline over emotion, and letting money follow clearly defined risk, not feelings. About the channel, The Backward Path. Welcome to The Backward Path, a channel built on one simple idea. Start from the smallest practical steps and apply inverse thinking, reasoning backward from outcomes to business, investing, and everyday life. We're after real happiness and durable success, not through grand slogans, but through simple, easy-to-use habits anyone can practice starting today. Your practical training roadmap for the whole series: Mindset Shift. See risk before return. Write your exit conditions before you enter. Hands-on practice. Use a 2-minute checklist. Run a 10-10-10 premortem. 10 minutes, 10 hours, 10 days. And split your capital into 3 buckets. Accumulate and sharpen. Keep a decision journal. Measure discipline. Learn from small losses instead of paying big tuition. Breakthrough and win. Take small, smart risks when you have an edge. Let gains compound. Protect and grow sustainably. Rebalance on schedule. Diversify intelligently, and protect your life capital through every cycle. A simple rule of thumb: keep around 10% of your portfolio for calculated, capped downside risk, and keep the rest working in safer core positions. Survive first. Compounding will do the rest. A New York morning. Dew clings to the stone steps at the Columbia Library. A young man hurries in, a minute late, hugging a thick stack of notes. His name is Benjamin Graham. He didn't start as a legend. He grew up in a Jewish immigrant family, lost his father early, and watched the crash of 1929 wipe out not just money, but a generation's pride on Wall Street. In a small classroom, Graham never promised get rich quick. He pointed to dusty balance sheets and said, thoughtful, in essence, "The one thing we can control is margin of safety, the cushion between the price we pay and a conservative estimate of value. If tomorrow goes against us, that cushion keeps us from a fatal fall." He wrote Security Analysis, 1934, and later, The Intelligent Investor, not to predict the future, but to survive long enough to enjoy it. Those years left a simple, sturdy legacy for everyday Americans. Protect first, then grow. In investing and in business, Graham taught us to assume we can be wrong, and to build disciplines so that being wrong only hurts small. Millions of Americans learned to buy with a safety discount, to pre-write exits, and to never shove all their chips onto one dream. 2 decades later, in Chicago, a grad student named Harry Markowitz walked into the library and realized that don't put all your eggs in one basket. needed a language better than a proverb. He turned diversification into math, variance, covariance, and the efficient frontier to answer a deeply American question. Thoughtful: how much risk am I willing to take for a given expected return? For the first time, risk wasn't a hunch. It could be plotted, measured, and negotiated. From 401ks to brokerage accounts, Americans learned to split risk, so one misstep wouldn't push an entire household off a cliff. But even the best models break on the shoals of human nature. In Jerusalem, then Princeton and Stanford, Daniel Kahneman and Amos Tversky opened a door into our heads. Prospect theory, 1979, showed we hate losses more than we love gains, often get overconfident, herd when we're scared, and sink into sunk cost traps. Those insights didn't just earn a Nobel, Kahneman, 2002. They shaped daily habits, from a single mom in Ohio weighing health insurance to a Texas diner owner deciding whether to borrow for a new grill. We learned that if emotion drives our hands, we'll buy high and sell low. If ego blinds our eyes, we won't see the cliff ahead. These three streams, Graham's margin of safety, Markowitz's quantified diversification, and Kahneman-Tversky's psychology, meet at the American kitchen table on the last Sunday of the month, where envelopes, spreadsheets, and banking apps are all open. No fancy jargon, just simple choices. Set aside rent, tuition, and a rainy day fund if layoffs hit. Over time, a practical layout spreads. Advisors call it the bucket strategy. We can call it the three-chest plan. The can-lose chest, a small slice for experiments, new business ideas or higher-risk assets with a clear, written exit. The shouldn't-lose chest, your core, income or stable growth properly diversified. The mustn't-lose chest, 6 months of living costs, insurance, and cash to breathe when the storm hits. This split isn't owned by any one person or tradition. It's simply what has worked across American crises, from the 1970s oil shocks to the dot-com bust, from 2008 to the pandemic. When storms come, the story turns very American. The news talks layoffs and an inverted yield curve. At dinner, someone asks, if revenue drops 30%, what do we do in 10 minutes, 10 hours, and 10 days? That's the premortem, a ritual that's spreading in risk management. In 10 minutes, cut what can be cut immediately. In 10 hours, call the bank and vendors to renegotiate. In 10 days, rework products portfolio, lower inventory, and raise liquidity. And because we know we panic, we tape up a 2-minute checklist next to the trade button or the signature line. Which chest is this from? What percent of total capital is the max loss? What's the numerical exit? What's the worst case and the 10-minute action? Does this duplicate risk we already hold? What data would disprove our thesis? If I don't do it today, will it matter in a week? You can spot these habits anywhere in the country. A couple in Minnesota swears off averaging down after reading about loss aversion. They write in big letters, "Don't add to a losing position when the original thesis is broken." An engineer in Seattle uses position sizing. Position equals risk per decision, violently entry minus stop. So one bad read never becomes a disaster. A nail salon owner in California caps any single project at 20% of capital and insists every big contract include a walkaway clause. Those small moves weave a safety net strong enough to catch a family when life turns rough.
At this point, you see the red thread running across a century isn't some mystical Jewish secret. It's a spirit of study, testing, and discipline, deeply associated with Jewish scholars whose ideas shaped modern American risk thinking. Graham teaches us to buy with a margin of safety and accept we can be wrong. Markowitz hands us the language of probability to spread risk instead of fleeing it. Kahneman and Tversky hold up a mirror to the enemy within: overconfidence, loss aversion, and FOMO. Together, those lights guide countless small daily choices that keep the financial lifeline of American families from snapping. If you came for fireworks, this ending will disappoint you, gently. It closes on a very ordinary American scene. Sunday night. The faucet hums, the dishwasher swishes, and someone in glasses reviews the month's journal, checking off exits honored, noting the near miss when they almost averaged down, and the rebalance that put weights back in line. 3 habits added, 3 bad ones crossed out. No confetti, just one sentence circled in red on the last page. Thoughtful. Let money follow defined risk, and let discipline answer instead of emotion. Tomorrow, the market may change colors again, but everyday Americans will still do the small, right things. Split 3 buckets, cap risk per decision at 0.5 to 1% for trading, or a 5% ceiling per business project. Keep at least 6 months of living costs. Run the 2-minute checklist before committing, and practice 10-10-10 whenever a storm looms. The most important lesson those names left us isn't how to win big. It's how not to die before you win, so your small edge has time to compound into real freedom. Thanks for sticking with me today. If you believe big wins start with not blowing up, with simple habits like the 2-minute checklist, 10-10-10 premortem, and the 3-chest plan, hit subscribe to The Backward Path right now. Every week you'll get 3 practical things. 1 story you'll remember when discipline gets tough. 1 action checklist you can use immediately. A free template pack for the risk ledger and 10-10-10 premortem. Link in description and pinned comment. Tap subscribe, turn on the bell, and comment discipline if you're ready to make risk management a daily habit. Protect first, grow after. See you in the next video.